Hello everybody. We're going to spend a few minutes talking about financial statement analysis. And on the screen is an Excel file that will provide us the inputs to our discussion. On the first two tabs, first is a balance sheet, and there's some information here about the balance sheet that you may want to glance over. I discussed this on an earlier video called the balance sheet and the income statement. And on the second tab is the income statement. So you may either want to look at that earlier video or pause this video and get familiar again with the information that's on these two financial statements and also provide a few sample ratios on these tabs. But we're going to spend the next few minutes talking a little deeper about how to analyze the information that's found on the financial statements and perhaps how to glean some insight to the company's financial operations and financial position. One thing that you may want to look at, the financial statements generally give 2 or more years of data. And one thing that you may want to do is simply look at how things have changed from the previous year. Looking at the increases and decreases. And a good way to look at it is to look at the percentage change from the preceding year. So I have the balance sheet here on the left side of the screen. And I've calculated the difference, the current year minus the previous year. And for example, in cash, we had $30,000 in the most recent year and $20,000 in the year before that. So that was a $10,000 increase, which is 50% growth over the previous year. So to get the percentage of change, you take the current year minus the previous year and divide that difference by the previous year. So by doing that, we can just look at how the balance sheet is changing from one year to the next, and are those changes, do they seem to be in line with each other, or do some things seem to be increasing or decreasing faster than the other items. Same thing with the income statement. For example, in the most recent year, 20x2, we had sales of $494,000. In the previous year, 20x1, sales were $450,000. So that was a $44,000 increase, which is a 9.8% increase over the 450 that we had in the previous year. So again, you take the difference and divide that difference by the previous year, and that gives you your percentage of change. So as you kind of compare these over time, we can see that in the last year, sales grew by 9.8%. Cost of goods sold grew a little bit faster than that. So costs were going up a little faster than sales, and that's why the gross margin or gross profit didn't grow quite as fast as the sales. However, some expenses did not grow as fast, and we can see down at the bottom that our net income actually grew by almost 16% over the previous year. So again, the percentage change allows you to compare the most recent year to the previous year, get a sense of how things are changing over time. Another way to look at the financial statements is with what's called common size financial statements. Here's a common size balance sheet, and on a common size statement, everything is listed as a percentage of the total. So for example, on the balance sheet, we're going to list every item as a percentage of the grand total. So every asset is listed as a percentage of total assets. And in the other half of the balance sheet, every liability and every item in stockholders' equity is listed as a percentage of the total liabilities in stockholders' equity. And of course, the total assets and the total liabilities in stockholders' equity is the same number for both sides of the equation. So we see that assets represents 100%, and here's the composition of the balance sheet up above it. If we do that for each year listed, then we can compare between years and see how the makeup of the balance sheet is changing over time. Just as one illustration, total liabilities were 40% of the total assets in year one, and 32.3% of the total in year two. So we can see that the total liabilities as a percentage of the total assets is coming down. Here's a common size income statement. And on the common size income statement, everything is listed as a percentage of sales. Remember that on the income statement, the total is at the top, and we're subtracting down from that. So again, sales is listed as 100%, and every item below is calculated as a percentage of that total. So what that means is in year one, we took cost of goods sold divided by sales, and that gave us a percentage of 28.2%. And in year two, we took 140 divided by the year two sales of 494,000, and that gave us a 28.3%. So as a percentage of sales, the cost of goods sold is relatively constant there. So we've looked at a percentage change from one year to the next. We've looked at common size, which again puts everything as a percentage of the total for that year. And now we want to look at a few various types of ratios that help us to get a perspective of relationships between significant items in the financial statements. So please don't be scared by this page. The way I have these listed is here we have some liquidity ratios going across, and then we're going to have some ratios that measure efficiency, and then we have some ratios that measure leverage or measures of the amount of debt that we have. And then at the bottom we've got some profitability measures that help us to monitor the performance of the company in terms of profit. When we talk about ratios, remember that a ratio is one number divided by another. So for example, a ratio that you're very familiar with is miles per gallon. And you would calculate it, as you know, if you went 200 miles and you used 10 gallons, you would divide 200 by 10, and that would be 20 miles per gallon. And so that's a relationship between the number of miles that we're driving and the number of gallons that we're using. Well, that's the idea as we look at financial ratios. We are looking at the relationship between items in the financial statements that give us insight, again, to the financial performance and the financial position of a company. With regards to liquidity, in other words, how well positioned are we to pay back debts and expenses that are coming up here in the near future. One thing we want to be aware of is what is our working capital position. Working capital are those assets that we're constantly using up and replacing, things like cash, accounts receivable, inventory, supplies, things like that. If you take your current assets, and by the way, all of these numbers on this page come from the financial statements on the first two tabs, and I've tried to color code them so you can find them easier. Items in blue come from the balance sheet. Items in pink come from the income statement. And then items in the light yellow relate to a calculation that I've made. And then I have a couple of other colors that try to help you just track things from one part of the page to another. And we're also looking at the most recent year. So for example, the current assets of $65,000, that comes from the balance sheet for the most recent year 2, and the current liabilities of $42,000 came from that same year. So in the working capital is the current assets minus the current liabilities. That gives us a net working capital of $23,000. Another way we might compare them is if you take the current assets and divide it by the current liabilities, we call that the current ratio. And like in this example, if we divide that out, it gives us a current ratio of 1.55. Of course, that's a reduced fraction from what we started with, so there's an understood 1 underneath that. So this means that for every dollar of current liabilities, we have $1.55 of current assets. So again, we're looking at these assets that are either cash or near cash, and how well positioned are we for paying liabilities that are going to be coming due in the near future. An even more focused liquidity measure is called the acid test ratio, oftentimes called the quick ratio. And with that, we're looking at specific current assets that are very close to cash in their composition. So this tends to be, the quick assets tends to be cash, accounts receivable, and short-term investments if you have any of those. Or what you might do is simply take the current assets and subtract out the inventory, which may not be turned into cash that quickly. And so the current assets minus the inventory gives us what we call our quick assets. So in this case, when we divide that by the current liabilities, we have $1.26. So we have $1.26 of quick assets for every dollar of current liabilities. So what's a good measure? What should the current ratio be, or what should the quick ratio be? For all of the ratios that we're talking about on this page, the answer to that is simply it depends. Now we do have some benchmark measures that kind of give us a rule of thumb, but the whether or not your measure is good kind of depends on what direction is it going. Is it improving over time, or is it getting worse? Also, what did you want it to be? It could be that you were strategically trying to increase or decrease the current ratio. Could be that you compare it to an industry average, or better yet, perhaps you compare it to your strongest competition, and maybe that gives you a benchmark to gauge your own progress from. But as a rule of thumb, the current asset, if it's somewhere between 1 and 2, that tends to be looked at as sufficient. And on the quick ratio, if it's somewhere between 0.5 and 1, then that tends to be viewed as a safe area to be in. So for example, if you were looking at 1 as being the upper end for the quick ratio, and here we have a 1.26, that could mean that maybe we have a little bit too much tied up in quick assets, and we may want to find a better use for that. Let's look down here at some of these efficiency ratios. Efficiency ratios primarily are focused on what we call turnover. Turnover has to do with how frequently is something being used up and replaced, So for example, inventory turnover, which is a very common performance measure, we calculate it as cost of goods sold divided by inventory. So the cost of goods sold is found on the income statement, representing the cost of the inventory that went out the door, and divide that by the balance sheet number for inventory, which represents how much you have on hand. So what we're doing is we're comparing the amount of product that went out the door with customers throughout the year to the amount that we have on hand right now, to get a sense for how many times is that inventory turning over during the year. And so in this example, the inventory was turning over 11.7 times, and if you divide that into 365, that gives you a little over 31 days per turn. We can do the same thing with accounts receivable turnover. We take the sales for the period, in this case $494,000, found on the income statement, divide that by the balance sheet number of accounts receivable, representing what customers owe us at a point in time. And in this example, the receivables were turning over 24.7 times in the year. I say in the year because that's the time period that these sales were collected over. So if it was turning over a little over 24 times a year, that's like twice a month. So that's pretty quick turnover. Divide that into 365, and that's an average of 14.8 days per turn. That would be your average collection period. These two measures that we just looked at, inventory turnover and accounts receivable turnover, if we combine those two, let me scoot the screen over. If we combine those two measures, we have what we call the operating cycle. A company that is in the business of buying and selling inventory. Here's the cycle that they constantly go through. They buy inventory, it sits on the shelf until they sell it, and then after they sell it to a customer, if they sold it on account, they have to wait a certain number of days until they collect from the customer. Well, we just calculated that it takes a little over 31 days for that inventory to turn over. In other words, it spends about 31 days on the shelf, and then it takes another 14.8 days to collect from the customer. So we've got money going out the door to buy our inventory, and then we got money coming in the door over here when we finally collect from our customers. So this operating cycle is taking a little over 46 days. And so that's a very important window of time that a company will consider as they think about their cash flow needs and how long they have to wait for money to come in from customers and so forth. couple of other measures of efficiency. One is our total asset turnover, which is if you take your sales and divide by total assets, and in this case we had a measure of 1.43, and what that really represents is that every dollar invested in assets is generating $1.43 in sales. If we, not sure why I deleted that there. If we look at the more specifically at fixed assets, if you take your sales and divide by your fixed assets, then in this case we had 1.76 times, meaning that our fixed assets, our investment in fixed property, plant, and equipment is turning over 1.76 times, or every dollar invested in property, plant, and equipment is generating $1.76 in sales throughout the period. Now, of course, fixed assets are not constantly being used up and replaced and used up and replaced the way inventory is, but still it's a measure, the fixed asset turnover and the total asset turnover, those are measures of how efficiently we're using those investment dollars that have been put into assets. Some companies, like the fixed asset turnover, some companies might try to get a little more intuitive as they think about the dollars that their fixed assets are kicking out. Like a retail store might look at sales per square foot. So in other words, how efficiently are we utilizing the square footage of the store? A hotel might look at sales per room night, and so they're thinking about how efficiently we're using this, the available rooms that we have to generate sales dollars. Or an airline might look at their sales per passenger seat, and so again, how efficiently we're using that investment, significant investment in airplanes. So many of these ratios can have more specific application depending on the industry that you're in. Okay, let's move down to the next category, which are leverage ratios. When a company that is using financial leverage is using debt to help generate growth, and hopefully they are using those borrowed monies to invest in profitable opportunities that are generating more profit than the debt is costing. So that's the idea behind leverage. If your borrowed dollars are generating profits more than those borrowed dollars are costing, we call that positive leverage. And if the borrowed dollars are actually hurting you, meaning costing more than they're generating in profit, we call that negative financial leverage. But we'll look at a little bit more at that in a second. These measures in this row are various ways of getting a sense of how much debt we have in our financial structure. If we look at the total debt ratio, sometimes called the debt to asset ratio, divide your total liabilities on the balance sheet by your total assets on the balance sheet, and we can see here that in the most recent year that comes out to be 0.32 or 32%. So 32% of our assets are financed with debt. Another way to kind of say the same thing is divide your total liabilities by your stockholders' equity. And in this case, that comes out to be 0.48 or 48%, meaning that for every dollar that we have in stockholders' equity, we have 48 cents in total liabilities. And so each of these are really just a different way to look at how much debt is on the balance sheet. Of course, that debt is going to cost us interest, and so we may want to see, well, how well are we covering that cost of interest? And so if we look at our EBIT, which is on the income statement, I'll look over there. EBIT is earnings before interest and taxes, and we see it's $84,000 in this year. If you look at your earnings before interest and taxes, and then divide by the interest expense, it tells you how many times you are covering that interest charges for the year. So basically, how much cushion do you have in your income statement in order to continue covering the charges for debt? And then one other measure that we actually will be using in a minute is called the equity multiplier. It's calculated as total assets divided by total equity. So in this case, it's $1.48. Again, that relationship is determined by, these assets are financed with either debt or equity, and so the more debt we have, the smaller the equity will be. So this measure, the equity multiplier, is impacted by how much debt financing exists. And so it's another measure of how much debt is in the financial structure, and we're going to be using that here in just a minute in another calculation. Okay, and finally we're down here to profitability ratios. We may want to look at how much profit we have built into the sales price above our cost of goods sold, and that's indicated by the gross profit percentage. Remember, on the income statement, your gross profit is a little subtotal. Sales minus cost of goods sold is your gross profit. And so the gross profit percentage indicates how much of the sales dollar is markup above cost. And so in this case, 71.7%, almost 72%. Well, that means that out of every dollar of sales, 72 cents represents markup. The other 28 cents was our cost. That's pretty, as far as examples go, that's a pretty high markup. Another measure of profitability is looking at the bottom line, net income as a percentage of sales. So divide net income by sales. Here we have 10.87%, meaning that out of every dollar of sales, we've got almost 11 cents of net income. Of course, the other 89 cents went to various expenses. And so we may want to further analyze what those expense percentages are. Another measure of profitability is looking at return on assets. This is net income on the income statement divided by total assets on the balance sheet. And in this case, it's 15.5%. A way to think about that is if you were to put money into a CD, and if you put $1,000 into a CD and that $1,000 investment earned you $100, that would be a 10% return. You had $100 of income on a $1,000 investment. That's kind of the idea as we think about we've got dollars invested in assets and we want to see, so how much income as a percentage are those assets realizing, and just give us something to compare to other um, investment opportunities. And a similar measure is return on equity. So this was return on total assets, and then as far as the stockholders are concerned, we might be interested in just the return on the dollars provided by the stockholders, and that should be in blue. Actually, let me see if I can, well, total equity, that number would come from the balance sheet, so that should be in blue. If I remember, I will put it in blue before I post this file. Talked about this equity multiplier a little bit ago, and that is a factor by which if you take your return on assets, you can multiply that by the equity multiplier, and that'll give you your return on equity. So that 15.5 multiplied by the equity multiplier gave us the 22.9%. So just indicating the relationship between those two measures. Let me show how these measures could be further used in combination. What's often referred to as the DuPont system. Sometimes the return on assets is broken down. Here's the return on assets, net income over total assets, and we can break that down into our profit margin times our total asset turnover. Now each of these measures we've looked at before. Here was our profit margin, and then the total asset turnover was up in the top right part of the spreadsheet. But when you multiply these two together, you see that the sales would cancel out. You'd be left with net income over total assets. So these two in combination, again, end up giving us return on assets. The purpose of breaking them out is to better understand, like if you look from one time period to another, what are the factors that are contributing to a change in return on assets? Well, it consists of two things. Number one, how profitable are your sales? We're generating sales throughout the year, but then we've got expenses at the same time, and so that net income, the profit margin, tells us what's left over out of that sales dollar. And then the other thing contributing to the return on assets is how many dollars of sales are these assets generating. And so that's the total asset turnover. And so we can improve our return on assets by, number one, improving our profit margin, perhaps reducing some expenses and improving the profit percentage. And secondly, by being more efficient with how we use our assets and generate more sales for a given level of assets, or perhaps even reduce the investment in those assets. So that's a way to break out the return on assets, and we can do a similar thing with return on equity by looking at the profit margin multiplied by the asset turnover, and then extending that by multiplying by the equity multiplier we talked about previously. And these three components, when multiplied together, also give us that return on equity. So by breaking them out, we can see that the three factors that we could focus on to improve the return on equity would be having um, getting more net income out of our sales dollar, which of course means finding a way to reduce expenses, getting more sales out of these assets that we have, more efficient use of the square footage or something, but generating more sales for those out of the facilities that we have. And then secondly, since we're talking about return on equity, perhaps altering our capital structure through the use of debt leverage to either enhance or if we were to experience more positive financial leverage or maybe even backing off on the debt if we feel like we're getting into too much debt, too risky of a situation. So that is a sweeping overview of various ratios that can be used for financial statement analysis, and I hope you can use that along with the reading in the book to gain insights to your company.